But I would say, given that what has been driving the equity market, at least the S&P, has been this AI trade, and given the fear that we've had around this trade in the past 2 weeks, I would potentially put a bit more weight on the AI than on potentially the Fed, especially that it seems that there's not big surprises coming out of the Fed meeting.
And greater risk then as well in that, because that seems like you could see a potential slowdown and parts of that, and some asking the question, well, show me the money now. You know,
Yes.
you've had all this AI capex.
Yes.
Now it's about how's it making me money.
Yes, so basically that's the biggest worry that's currently happening within the market, is that we're investing very heavily within the capex cycle. It's a brand new technology, it's potentially revolutionary. Nobody wants to actually not invest, and the risk of underinvesting is now higher than overinvesting. So investors are now questioning, okay, when are we going to see the money? And are we really going to see that much money that's warranting that large amount of capex? Now, it's still a question mark. But what happened is last week when Google spoke, and they mentioned that brace a bit lower type of margins, and also we're not increasing our capex, people started actually worrying, is that a new trend? And as you all know, equity markets don't really like when margins start squeezing on the downside.
Yeah, the problem is the market's being typically dumb, isn't it? The market, because it hasn't done its reading into how technology actually works. And
Yes.
every single technology that's ever worked in the history of mankind and humankind, if they work, they take a lot longer. The diffusion of these technologies to the broader economy, to the broader society, to the broader corporates, it takes a lot longer. So you have this initial excitement where everyone overpays for assets in the very short term. Then you have the bubble bursting because people think, hang on a second, we're not realising profits today or tomorrow. And then actually, funny enough, the railways are still here. The railways still work. The internet is still here. It's working beautifully. The wheel is still here. It seems to be working okay. But the fact of the matter is the market seems to think it wants immediate returns within the 1 to 3 years afterwards, or wants a trajectory. And it's just dumb. So it means a lot of companies, a lot of investors overpay, but the trend remains. I have no doubt that AI will do everything that people think it will do in terms of productivity, in terms of cost cutting more generally, and in terms of creating growth opportunities. What it means for society, that's another issue, and we should all be very concerned about some of those issues. But the fact of the matter is the market is so short term, it can't see the wood for the trees.
Yes, I couldn't agree more with you on that statement, and you frame it extremely well, to be honest.
Well, thank you very much.
If you want to come and join us,
no, I
we'll
worked
have a chat about
in the 90s. I've done my French banking. I'm going to stick with journalism. Thank you.
But the problem here is people are potentially dumb. I wouldn't call them dumb. The reason behind it is because when you have tried not to invest and for the same rationale as you try to express, you've unfortunately underperformed the market. And that's the biggest problem that you currently have. The fear of underperforming your benchmark is so big that you cannot buck the trend. You see what I mean?
Yeah,
so
100%.
It's the current Mac 7 / NVIDIA AI trade is such a unique type of trade that we haven't really seen. It's concentrated amongst the largest cap. It's a one-factor type of decision-making, and your underperformance or overperformance versus your benchmark, which is S&P, is a simple decision. Are you overweight or underweight this big tech? And if you start becoming rational, and you have a bit of gray hair, because you've been here and you've read quite enough of history, you would say, I should be underperforming. I wasn't talking about Steve.
I agree. The grey hair comes with a lot of baggage as well.
Okay, I take mine out so I never show if I have grey hair.
You wait till your beard starts going. It happened to me. That's why I don't have one. George, you take your water by all means. I'll make the question longer, just like my last one. But in terms of the trade here now, and I like the fact that we're seeing a little bit of a pullback and think, hang on a second, which ones are going to be the great AI players? Should we go for the picks and shovels, or should we go the people who are promising the greatest growth? There's a lot of dispersion out there on it, though. What are the right kind of trades our viewers should be putting on?
So, in my view, I cover Europe, and one of our largest calls continues to be ASML, because irrespective, as you said, we don't expect to see large monetization anytime soon, but we do expect an ongoing capex investment that should favor, like you said, the people who are within the building of infrastructure, whether it's data center, connectivity. Obviously, ASML is one of the largest picks around that. So yes, I would go for that.
And you get a significantly cheaper ASML than you would have done just at the start of this month.
Correct, and for non-fundamental reasons and more for geopolitical or political risks, which is another reason why I'm a bit more comfortable to own it, because fundamentally speaking, the earnings were actually quite solid. If anything, they were better than expected on many different aspects. And given the comments that we've seen from other companies, we don't expect a slowdown in order book anytime soon.